Gold's rally just hit a surprising roadblock, and investors are buzzing with anticipation. When gold looked set to surge higher, it instead edged down, wiping out earlier gains that followed an unexpected drop in U.S. producer prices, an outcome that had many convinced the Federal Reserve might finally ease policy. Here's where it gets controversial. Some market observers insist a one-time fall in producer prices won't shift the Fed's stance, while others argue it's exactly the proof they need to justify rate cuts. In fact, bullion sank by as much as 0.7%, slipping to $3,614.26 an ounce, about $50 below the peak reached earlier this week. For those new to this, producer prices measure what businesses pay for goods and services before they hit store shelves. When this index falls, it often signals that inflationary pressures are cooling behind the scenes. And this is the part most people miss. Gold's price swings reflect traders' evolving expectations for interest rates more than changes in the metal's basic supply and demand. Right now, many traders are betting U.S. borrowing costs will be lowered next week after this first drop in producer prices in 4 months strengthened that narrative. But the story isn't over. Later Thursday, all eyes will turn to consumer price data, a next key gauge that could confirm whether inflation is truly easing or still running hot. What's your take? Is the recent decline in producer prices a real signal that the Fed will pull back on rates, or just a temporary blip? Share your thoughts below. Let's spark a debate.